Good morning, good evening, wherever you are. Welcome into the EGA live stream and webinar. Happy Monday or Sunday night if you are in America and joining us. Hope you guys are having a good weekend. We're here to help you guys break down the markets as usual. We had a pretty interesting week this past week with lots of price action that was absolutely not expected. However, part of our thesis was intact. It still ended the week a little red for me, which is pretty normal when you keep losses small. You tend to have a longer life with your portfolio and trading accounts. So keeping your risk management at bay was absolutely the right tactic this week. How many of you had a rather tough trading week? Put it down in the comments if you were struggling this week, if you were betting to the upside or betting to the downside. What were some of the tickers that you guys were playing? I would love to hear from you guys. Make sure you drop down any tickers that you want me to break down, and I will do that for you during this webinar towards the end. So as usual, we will take the same route through breaking down these markets. We'll cover the macroeconomic part of the US market. We'll also cover the technicals for SPX or S&P 500, NASDAQ, the Russell 2000. We'll also move on to the VIX, the bond market, and then some potential opportunities that we are looking at this week. So that's usually the flow of this webinar every Sunday. If this is your first time here, welcome in. And don't forget to click the like button. And if you haven't subscribed to us, definitely drop a subscribe, because we do this every Sunday for you at absolutely no cost. So welcome in. Okay, so let's just go over very quickly the macro conditions for the S&P 500. We have a lot of institutional side leaning towards a more aggressive hike in interest rates in the future. The Fed in the past 2 weeks signaled a 25 basis point hike, which is 0.25%, bringing the Fed target funds rate between 0.25 and 0.5%. Remember that when we talk about the target rate for the federal funds rate, we're talking about the interbank lending rate at which banks can borrow from one another overnight, right? And for those of you that don't know how the system works, maybe it might be a little refresher for you guys to understand how the Fed conducts its operations. So you have the Fed, and you have let me get my writing pad. Hold up, it'll be much easier that way. Let's do this here. There we go. So you have the Fed, right? And this is your Mr. Fed, who Jerome Powell is the chairman of, right? And very quickly, a recap. You have banks that are your big institutional banks. Banks like Wells Fargo, Chase, Bank of America, even JP Morgan and Bank of America, JP Morgan, Goldman Sachs, which are investment banks, are also wholesalers and market makers. So they move a lot of liquidity as well. Now, in order for the Fed to give money to the system, right, which you were doing very abundantly, right, they have to buy bonds. So bonds have to come in, right? Bonds have to come in, and money goes out. So this is all done obviously electronically. It's no longer physical. They don't move any physical bonds or physical cash. It's all electronic. So everything in this form is in the form of credit, right? Credit. So the word here that is important is credit. Okay. And when credit flows into the system, this is bank, let's just say bank 1 and bank 2, right? Those banks can then lend those funds out into the public, right? Or let's just say businesses or whoever else in the general population, right? So when we talk about lending, we are not talking about the rate at which the Fed lends the banks. When we talk about the target rate or the federal funds rate, this is the rate at which banks can borrow from one another overnight. This is what we call the federal funds rate. Okay, so a lot of people have a misconception of what the federal funds rate is, and I wanted to just give you guys a quick recap because it's an important part of learning about stock markets, credit markets, finance in general, right? The more you know, the better. And now, why is that? And why is that something that is important? Well, the rate at which banks borrow from one another, if it's higher, then they have to pass the cost on to the consumer, right? So the higher the rate goes, or the perceived rate at which banks borrow from one another, which is controlled through the mechanisms of the federal funds, then the higher the borrowing rate, which is translated onto the public. Now, obviously, you would think, well, if interest rates are rising, that means that banks would be able to pass this cost on to consumers much simpler, right? And doesn't that just mean that banks' profit margins would rise? Absolutely, it does, right? And so this is one of the obviously macroeconomic structural plays that you can make longer term, right? Financials are one of the more sought after sectors that we look at when we are looking at the federal funds rate increasing, or when there is any kind of a hawkish federal funds mentality. So in just a recent time, we had that happen. Now, the Fed didn't really increase interest rates very aggressively in the last rate hike, but they are projecting to do so in the future. And why is all of this happening? It's mainly because of inflation. It's mainly because of the economy that is strengthening, and they don't want this economy to falter. So instead of letting prices rise too quickly, too fast, what they're doing is they're controlling the rise of asset prices by increasing the cost of borrowing, right? If you increase the cost of borrowing, people borrow less, and if people borrow less, then it kind of it doesn't stall the economy, but it cools it down. So this is a cooling of the economy during the start of another expansionary bull phase. Now, a lot of people are touting that we are going to go through a recession, but it's more likely that we will see a more rampant inflation before we see recessions of any kind. One of the things that will first happen will be the bond market that will signal a recession. And right now we are seeing just a little sign, but not really anything concrete just yet. And so there's really nothing to worry as of just yet. Now, so that's a little bit of macroeconomics and a little bit of an idea of where we are in terms of the interest rates environment, right? But then you also have to look at credit cycles. You also have to look at where all that money is coming from. Remember that majority of what we deal with is all credit, right? When you buy something, you are buying it on credit usually from the bank, because your bank pays on your behalf, and that money is sitting in your bank account, right? And the bank uses that money and multiplies it through the money multiplier effect by lending it out, and each dollar of that can multiply up to 10 times, right? Well, these are all basic economic terms that you should know, and I'm pretty sure that many of you do. So if we translate all of this into the bond market, then you see what has happened, right? Obviously, in the past couple of months, since November, where the bond market peaked out, or December, on a pullback, during this time, a lot of people were expecting inflation to be transitory and not run so high, and then the hammer got dropped over here, where there was a conversion of that mentality into inflation staying longer, and the problem becoming a bit more stickier. And then there was also somewhere around here, the war between or the conflict between Ukraine and Russia, which further exacerbated the problem. And then the bond market went into a full flight mode, right? Now, why is the bond market doing this? Well, remember that this adds pressure to the Fed's already selling bonds. Remember that when the Fed wants to bring money in, they have to sell bonds in order to do so. So they sell bonds to banks. Banks buy the bonds at a cheap price, and then that money comes into the Fed. Okay, so it's not necessarily about the cheap price that the banks buy it at, but the mechanism is such. So money flows from the system to the Fed by the sale of bonds. Okay, and you can see that the sale of bonds, especially, we look at two proxies for this as an ETF. One is the TLT, which is the 20 plus year bond, and then we look at also TLH, which is the 10 plus year bond, which is this one right here. And you can see that obviously the 10-year bond has been more aggressively sold off, mainly because this is more shorter term than the 20-year plus bonds. So this is 10 to 20, and the other is 20 plus, so 20 all the way to 30. Okay, 30-year is the maximum tenure for usually a treasury bond. Okay, and usually attracts long-term stable investors of kind. So bonds are another different mechanism that I won't get into, but they have coupon payments, and they're tied to interest rates as well, because there's a time value component involved, and you have to understand how a bond works. But the most basic thing that you need to know about bonds is very simple. If you're just a regular investor, is yields are always going to be moving inverse. Okay, oops. Yields are always going to be moving inverse to the price of a bond. So in other words, if the price of the bond comes down, then yields go up. Why? Because if a bond is cheap, for example, then not many people want to buy it. If it continues selling, then what has to happen in order to attract investors? The yield, or the return on that bond through coupon payment, has to increase. Okay, so that's the mechanism of a bond. And by the way, this applies for all bonds, right? Not just treasury bonds. It applies for a lot of different kinds of bonds. Okay, so a bond is like a kind of a asset that you can invest in, where you get something called a coupon payment. Okay, and so then over the life of the bond, let's say you have a 30-year bond, then while holding that bond, you will receive minuscule payments. It's kind of like dividends, but it has a different mechanism altogether, because that par value of the bond will always come back to $1,000. And okay, it's a little more complicated than that, but I'm just going to tell you that there are coupon payments involved, and so the yields have to go up to kind of compensate for that. Okay, and that's the basics that you need to know about this. So why are we focusing on the bond market? Why is it important? What makes the bond market signal to us anything whatsoever to do with equities or stocks? Well, remember that credit is the risk appetite of investors. If people are not willing to put money into safe investments, then it's going to be a very interesting balance of risk and reward with riskier investments such as equity, right? So this is one of the reasons why we look at the bond market as a proxy to understand risk appetite. All right. Very quickly, if you can hear my voice, welcome into the live stream. I hope that you guys are having a good weekend. And we're just doing a macroeconomic and a little short lesson on bonds and the Fed. I just like to repeat these things from time to time so that you guys have a good understanding of all this. Also, if you want me to break down any tickers, drop them into the comments. What's up, Mark? How you doing? And also remember to like the stream, as well as subscribe if you haven't. If this is your first time here, welcome in. Okay, so let's have a look at the general technicals, right? So macro standpoint wise, we have higher than usual basis point hikes coming in the future. So we had just a 25 basis point hike, just to wrap up the macro part of this. We had a 25 basis point hike, which is, when we talk about basis points, 100 basis points equals to 1%. 100 basis points equals to 1%. So therefore, 25 basis points is 0.25%. And what we're looking at is, right now, we're looking at the next hike to be at least 0.5. There are at least 3 Fed chair people who are looking at a 0.5 basis point hike for the next hike. So now, is that going to be a concern? Well, majority of this has already been priced in, so no, not really. And when we say priced in, what does that mean? The bond market has already priced in the possibility of this. Okay. And now we are looking at just the overall sentiment of the S&P 500. So what the heck happened this week? Now, I'll be the first to admit that this week had me confused as well, right? It had me slightly confused until I started realizing what was happening. And when I did realize what was happening, it was a bit too late. And it's okay, you're not always going to get it right. But, sometimes it pays to have a playbook where you are executing from certain scenarios. Now, this week, we did mention that a rally would be met with a pullback. Now, I think we were here when we opened on Monday. And we kind of, we had a very interesting short pullback. We weren't wrong about the pullback, but we were wrong about where the target would be. My intention was 4,400 to be a pullback. We didn't really get there. We got very close to it. I was thinking even 43.20 would be a possible pullback level, but we never got those levels. In fact, we just continued chugging along, and then until we reached like 44.50 is when I started to realize that something is off here. And I started to realize that there were a lot of short positions that were covering from here. So what actually happened this week was what we call a short squeeze. This is where we have market participants that are overly bearish, right? And we have been bearish for a while, right? We've been moving in a downtrend. And more people get bearish, which we knew was the case 2 weeks ago, 1 to 2 weeks ago. I in fact posted about this on the Discord, but then I didn't have this at the back of my head, thus not really giving me the immediate light bulb moment, but I got there eventually. Now, what happens in a short squeeze is, remember that when you are short something, right? What is the short mechanism? When you are short something, you have to go out and you have to borrow shares, or you have to borrow, some kind of financial instrument. You borrow it from person A, right? And then what happens? You wait for the price of that something to go down. So you borrow, but then you sell it, right? This is a mechanism provided by your broker. And as the price comes down, you start to make profits, right? And then when you are done making profits and you want to buy it back, then you sell, okay, to person A again, okay? So you buy it from person A, you sell it back to person A. Or, well, in the market, it will be open market, so you're going to sell it to whoever you want, right? But that's the idea. You borrow shares, you short sell, and then when you are ready to close your position, guess what? You have to buy that position back. So when you short sell, you are selling to open. You have to buy to close, right? So sell to open, you have to buy to close, okay? So when you buy to close, you're essentially what you're doing is putting upward pressure on the market. Now, this wouldn't be a problem if there were very few people who, pretty much were just thinking the market's going to be bullish, right? But if there is a overwhelming consensus that everybody is bearish, which was the case a week back, right? There was a lot of short positioning through the open interest that we could see. Then this causes a violent squeeze to the upside, okay? Because what happens is there will be a bunch of people who will cover their short position, and then that might cause a bunch of people more to go short. And then a bunch of more people go short. And then as we continue to move up, all of these guys, everyone here, by the way, I was one of these people this week, so I'm laughing at myself too, right? Then these people get squeezed out of their positions, right? Why? Because the more they lose, the more painful it gets. Then they have to close out their shorts, and when they close out their shorts, it ends up pushing this index even higher, right? So that is the definition of a short squeeze, okay? And that's kind of what happened this week. I know this happened because I was looking at the data, but it was a post-mortem analysis. So as of right now, that's the main thesis here. Now, does that mean that we should remain bullish forever? No, absolutely not. We need to wait for that wave of short covering to be over, and then we can play the actual short down. There is a very high likelihood that we come back to retest 4,400 at some point, or even 43.20. These two levels remain significant levels for a retest before we move to the upside again. And because these are high demand levels, as you can see, there's even a volume shelf at around 43.20. Oops, sorry, wrong indicator. You can see that the volume shelf lines up very perfectly right here, right? We have a very high volume with volume profile there, which means that a lot of price action was happening around this area, right? The distribution of price action has been very concentrated in this area in general, right? So the retest is definitely coming. It's when it's going to happen, all right? Welcome in, Lakia. All right, got you. Disney, Ford, Apple. Bearded Baby 93. My comment must have got lost. Which comment? Post it again. Nelson, Baba, and Square. Okay, cool. I will get your tickers in right after I'm done analyzing this stuff. So with the S&P 500, my main concern here would be, or not concern, but my main forecast here would be, wait for the shorts to cover fully. And I think that's likely to head into the 4600s. But if we do break 4600s, that's going to be interesting. I will say that. Above 4600s, I will be more inclined to go long than I would short, because then the squeeze continues and we just continue moving to the upside. We have seen, you know, a lot of this kind of violent movement to the upside, and bull markets can be very violent as much as bear markets are. So remember that. Then we look at the QQQ, which had a similar trajectory, right? Bigger squeeze here than we had on the others. And you know, a lot of this, now if you were here last week, you would have realized we covered the sector sentiment. We cover it every week, right? And this is one of the things we post on the Discord. And last week, you know, a lot of these were just halfway. They were kind of you know, moving halfway, and I was mentioning that we have a lot of room to go, you know, lots of room to move on semiconductors, lots of room to move on technology and retail, and energy was cooling, etc., etc. And you can see what happened during the week. We got a huge snap rally to the upside. This is all the institutional side research, of course. And apart from that, we have the gamma level report here, and you know, a bunch of other things that I just posted this morning for our Discord members to read on the premium channel. But I just wanted to share that, you know, these sector of sentiment reports, they really do help in understanding things from time to time. Now with the QQQ, what's interesting is we are approaching a key level of obviously resistance here, right, at 359. If we continue above this, then 370 is likely to be a retest level, and then there's a little mini like resistance up here at around 367 or so. And we'll see how this goes, but I think the pullback is going to be around 350, 347, around this range here. There is a dual zone right there that we want to fall back onto for the next rally to the upside, right? With the Russell 2000, we're sitting on a very clear pivot, right? We've been moving back and forth here a couple of times now. If S&P 500 and NASDAQ continue to correct this week, then the Russell is going to come down. We saw a lot of institutional flow on this one specifically. Institutional flow has been betting on 194 puts for May. 194 puts for May. That's what the flow has been saying. That's through the month of April. And they obviously sold some options against those as well to lower the premium. So you know, don't take it too you know, crazily, right? But the Russell does seem like it might, you know, pull back a little bit and give us that little consolidation. If it breaks above and starts bouncing above the 207 range, 208 range, then I'll go long, right? Protect my downside position. But then we have the VIX. Now this one is interesting. The VIX with a very big you know, slide this week. Remember what the VIX measures. The VIX doesn't just measure volatility and fear and all those things. It also measures the amount of out the money options bought by institutions on the S&P 500 futures, right? So what this is saying is now that the volatility expectation of upside and downside skew is getting less violent. Okay, that's what the VIX is saying here. In other words, volatility is draining out of the market, and now on a pullback on the S&P 500, we will start to see a lot of long positioning for the next bull run. Why? Because when the VIX is expensive, everything is expensive. Okay? When the VIX is up here at 36 and 37, all options are expensive. And if you're an institution, you can buy equity, but remember that always before you buy equity, you want to buy the derivative position, because the derivative is dependent on the equity price. So therefore, they will always execute options first and then buy the equity, right? So you got to think of things logically sometimes. There will be a pullback. Don't worry. You didn't lose the rally. You're not too late. You remember, like all those things don't even let it cross your mind. Okay, it's no point. There's no need to FOMO and then go and buy leaps on SPY or whatever and this and that. Trust me, you will get a pullback. It will happen. Okay. You just need to be patient and let things pan out the way that they will. Okay. Then, next up, well, we did speak about the bond market. I'm now adding positions to TLT, mainly because this seems like a very strong demand zone to pick up. The right side of the bond market, the tail of the bond market. I might be completely wrong here, but I'll manage my risk anyway if I'm wrong. But below, 126 is a really good spot to buy some. I added a small position right over here at 128, 129, and then I think overnight on the Discord people made like 40% when it rallied up to around 133, 132. But I'll be holding my position just a little bit longer, and then I'll be taking profits on it soon when I get a bounce. So that's one little trade idea that I am looking for a macro standpoint. It doesn't exactly line up with my macro idea, but I like to be a contrarian trader. And I typically try to make moves that are non-aligned with market conditions. Okay, next up, things that I'm looking at. There are some tickers. However, remember that as of the sector sentiment update, I just want to point out the things that changed this week. The ones in bold changed. Healthcare is now overbought, so is financials. Industrials, retail and semis are approaching overbought, and so is technology. Energy and utilities are shortable. And so these continue to be the key sector rotations for this week. So we're looking at Moderna. This is on the NASDAQ, but it's under healthcare. And healthcare is overbought. We did get that sell-off towards the end of the week. It's 7% sell-off. So I'm not really ready to trade this once again, but we'll see. Industrials. It was looking shortable, but then ended the week with a rally. It was interesting because I think that snap rally should head into 106 and 105 this week, presenting a nice $2 to $3 upside if the S&P 500 or the Dow Jones instead can, continue its momentum. And then you have financials, which is I've been watching for a while, but I need that break above $40 really, or 39 something, to make this worthwhile to take to the upside. The risk to reward ratio here is, you can make it fit if you take your risk off at around $38.50 and you play the upside all the way up to around 41. You can possibly make the trade idea fit, like a 1:2 risk to reward ratio here. For those of you that can't visualize, let me show you what I mean. Let's say you were to do this, right? Roughly a 1:2 risk to reward ratio, right? If you were to take your risk off below here, and then you take your profit somewhere up here, which is likely to, if it really continues in this trend, then you'll see it continue higher, right? So that's something that might happen. We'll see how financials move this week. But once again, this one would align with the macro conditions, with financials, and with the federal funds rate hike. The only thing is I just don't like the setup because of this break down below, and then it looks like it's forming lower highs, and it seems like it's almost looking like it wants to reverse out of this pattern. We'll see. I'll give you guys an update as we go along. Marvel Semiconductors, I mentioned this on the live last week. I don't know how many of you played it. Beautiful setup. Hit the 61.8 Fibonacci extension. On a pullback, this should be nice to take into the 77s. And then if it can, break above 77 or 78, and then use that as a support. We can see further upside into 90 bucks. This thing could pretty much go. Somebody requested Baba, so I'll do Baba for you real quick. Nelson, right? Okay, so Baba, this is had a very strong rally last week. We played the bounce up over here from 112 all the way up to 124, 125. We had some 125 calls. I think this was a 40% trade. Was it this week? Yeah, it was. I took 28% off it, but a majority of people closed 40% on this. This week's biggest winners were Facebook. We played a 0-day expiry on Friday. That was a nice one. With Baba, we're looking for a 127 target to retest this resistance up here. But the more that it starts to retrace down, then it's going to become less likely. This bounce here was quite promising. So currently, if you want to look at this a little easier, just turn on Heiken Aishi candles, and then you can see things a little bit easier. As of right now, this is kind of like in a pennant style. So anything that, if it starts to break, then you can see a possible bounce to the upside here. We'll continue to watch this week as well. I like this trade idea, but I want to only take it if I can find conviction and confluence. So a bounce would be good, but if a breakdown below this trend, then we start to see this thing kind of falter back down again. But that's what we're looking at here. Keep it simple with Baba. And then Apple, huge rally on some bullish news, index short squeeze, etc., etc. This was insanely massive. We knew 176 was a level for it to retest, but for me, the whole week, the main problem mentally for me was everything's risk to reward ratio was off, and I didn't want to overpay for something. I hate overpaying for things, and so that's the reason why I never took any of these trades. And then Tesla, also another monster rally, right? So with all of these here now, assuming this is the top here, you will look at the 50% retracement here. The 50% retracement on Tesla is going to be around 900 bucks. So that's another interesting one. A pullback here would lead us back into the 61.8, which is going to be 932. If the indices decide to have a little pullback, then 980 will be the first level, and then 932 will be the second level here for pullbacks. Let's also look at the VPVR real quick. And you can see that we have a really nice gap here. So this is going to be like a void. This will be an immediate snap fall down into the 920s, right? This is your volume shelf right here. Tesla collapses in this range between these two levels here. So that's something you should keep in mind. If it continues to move higher, then and it's very possible. You got to keep that in mind, but absolutely think that there's a possibility. And then semiconductors, these are now approaching overbought, but it does seem to me like there was insane bullish betting on NVIDIA this past week. So they've been betting on 290s the whole of this week, and so I'm definitely putting NVIDIA on the and NVIDIA and AMD are both going, as well as NVIDIA, AMD, and Marvel Semiconductors are going onto the snipe list this week. They will be automatically added to the snipe list for potential setups this week. Marvel, NVIDIA, and AMD. If you don't want to play any of these, then play SMH, which is the ETF for all of these. Okay, cool. So those are some potential setups. I have a lot more. I'll be posting them on the Discord later on. And okay, let's see. Disney. Let's do some of the ticker breakdowns. Hold on. All right. Let me get my thing out of the way. If you guys can hear drilling in the background, that's my neighbor. But you know what? It's all good. You guys can hear me fine, right? Take a sip of my water here. Okay, so we'll do Disney. I don't like the setup, just looking at it first right off the bat. It does seem to be... this doesn't look that great. It needs to really clear some key booby trap levels here. Main booby trap levels are going to be above this, 142. And then there's a whole range here that's really tricky. 147 too. And then the upside there is up to around 158. So if you're looking at the upside play here, then you know you need to cross at least 150.45 and beyond, and then bounce on those levels. So you need something like this, and then you can move to the upside. I don't like this setup very well right now. So we can revisit this when it looks better. I still feel like this is more downside driven than it is upside driven, but who knows. Ford, another one of those consolidation after a huge pop. This is like a meme mania. This reminds me of meme mania. Buy the news, sell the rumor. Complete reverse of buy the rumor, sell the news. People bought the news and they sold the rumor. Here, they did the reverse of what was usually expected. Once again, you own shares, cool. If you don't own shares, this is not worth trading. Very choppy price action, no range, no volatility. Trading options here is like a death trap. So definitely not gonna trade this one. Apple already mentioned this is likely to be a 176 cap resistance, and then we should get a 50% pullback of some sorts, and that would be around 163 or 166 pullback on Apple. Granted, this wave has not been complete yet. I'm drawing a retracement based on a projection here. Baba, I covered that. Square, let's see. Square was interesting. I was thinking of trading it this past week, but then price action wasn't that great. Let's see. So this one had decent bounces, but didn't clear above the 131.18 level, which I wanted to hold. This was the main level which we wanted to hold. Above this would have been bullish, but we'll see how it opens up. If we can hold 131.18 or like 131 in general, let's just say, this coming week and start to trade above it, then we're looking at extension into 154 on Square. That's what I would say on this thing. That's my projection. If we get rejected here, then we come down all the way back. So that's the projection. Was a good week for me. Not this week. Tickers I played: Tesla, NVDA, AMD, Affirm, Beyond, FB. Tickers I'd like to see: Tesla, NVIDIA, PayPal, Microsoft. I don't expect all. Okay. Well, we covered Tesla. We covered NVIDIA. Well, I'll put NVIDIA on the Discord. PayPal. Okay, let's do PayPal. So PayPal is another one of those that are, you know, very skittish right now. The only thing that I find interesting about this one is there's a lot of insider and congressional interest. So senators and I don't know, a bunch of random ass people are buying the dip on this company. It might take months, years for this thing to actually rebound. Who knows? Just mainly because they had bad earnings report after they are already expected like problems in their space. Now, I don't personally own PayPal as a stock, mainly because I've explained this before. They don't have a strong competitive moat. I've mentioned this multiple times before. They don't have like a competitive advantage. Like anybody can come along tomorrow and compete with PayPal. They don't have some, you know, out of box technology that is patented or, you know, that puts them in a unique position. So they're always going to be fighting with their competitors, and you know, even if they make first moves for certain things, it's just not going to put them in a good space. So from a macro standpoint, I just don't see the alignment there. From a technical standpoint, this thing has been way oversold. It probably will rebound at some point, right? On the weekly chart, this thing is insane. But once again, if you're looking at technical levels, then wait for the break above, let's just say 120, before taking any upside here. And then when you do take the upside, be extremely, extremely cautious, because I know everybody's going to be like, oh my God, look, there's a gap fill here. This is crazy. It's going to gap fill. It's going to go for the gap fill. No, this, right? Everybody's going to be like, oh, there's a gap fill. But remember that not all gaps get filled, okay? So be extremely careful, because this gap may not get filled immediately, okay? And they might paint it to go like midway through the gap, and then everybody will buy in, and then they'll slap the price down. That's a very high possibility as well. We've seen that happen multiple times. So gaps are not meant to fill 100% of the time immediately. So be very careful, especially since this is a huge gap. This is a 139 or 140 all the way to 170 gap, okay? And that's a big freaking gap. So don't get misled here. And then you said Microsoft. Microsoft also rallied this week, but not as much as Apple. Microsoft to the upside looks nice. So this is actually going to go on to the snipe list. So we'll have a lot of semiconductors and Microsoft. The Microsoft up to 311 looks beautiful for this week. If we can get that little, you know, pop. Okay, then we have NEO. So I know there's a lot of institutional interest on NEO, and also a lot of people buying the stock right now. Let's see here. Was this? Ooh, this was decent volume. Decent volume in the bounce. Interesting. Well, not like super high volume, but decent volume. Still not out of the woods though with NEO. We still need much better confirmations on NEO. Above 23.42 is really where I will only touch this thing. Like setting an alert here at 22.91, and then just wait for that to kind of, you know, go off. We need a break and then a retest, and then even here it's kind of still not out of the woods yet. It still needs to move higher and still form a support above 26 bucks for this thing to officially be out of its downtrend. So remember, this is the high, lower high, lower high, lower high. It needs to go like this, and then like this, and like this, like this, like this, right? And then reverse out. And this is where that pivot's going to happen. So this dip here is the buy dip. So learn how to read these things, right? What else? TSM and Z. Same thing here. Needs to break above 108, 109 for me to even consider. To be really safe, above 111, to be honest. Needs to break above, and then only we can take this bullish. If not, it continues to be bearish here, playing the downside. Z. Oh, I just don't want to touch this. It looks so weird. Yeah, definitely not touching this. What's the market cap on this one? 12 billion. This stock was trading at almost $200. Look at that. My goodness. It's trading at $52 right now. What else? Intel was great too. Watch, didn't play. Look at dark pool flow on Intel on Discord. Yeah. I saw the dark pool this week. It was interesting. But yeah, that's all I got for you guys. Honestly, I'm gonna try and keep this webinar as short as possible. So I'm gonna actually end it right now. Do any of you have any questions, comments, concerns? Post your questions below, and then I'll try to answer them. Not ticker breakdowns, but like just any questions in general. If not, I'm gonna end the stream here, and then the rest of you who need anything at all, definitely post your questions on Discord, and I will get to it. For those of you that don't know about us, we have a private Discord community. You can join by clicking the link in the description below if you haven't yet. Also, we'll be holding another webinar this Wednesday, just so you know, options trading. Explained and simplified. I'll be going through various different topics of options trading, so make sure that you attend that webinar as well. It's going to be around the same time, so make sure that you turn up for that one. It's going to be a great one. Okie dokie. Well, I hope you guys have a great rest of your day, and I'm going to wait for a minute to see if you guys have any questions, and if not, then I'm going to get out of the stream because it's getting to around about 52 minutes at the moment. Remember to wait for the pullbacks on the S&P 500 this week before entering anything. There's really no rush. Also, make sure you smash the like button and subscribe if you haven't yet. All right, I will see you guys in the morning. See you on Discord. Ciao. Bye-bye.